Paul's first idea is TD Bank.
Yeah, so TD Bank, I mean, second largest bank in this country. They've got a great U.S. franchise, albeit that it's not kind of giving you the ROE that people want. Their acquisition of First Horizon failed, so they're one of the largest they have the most capital, I think, of any Canadian bank. It's trading at 10 times earnings, almost a 5% dividend yield. We really believe that over the long term, TD banks have done incredibly well in this country. People like to use the word oligopoly, but the reality is that there's rational pricing in that business, and they have lots of scale, right? And so I think they will do another acquisition in the States at some point in time. But and there's been some issues with kind of the regulatory environment because of that First Horizon deal, and they maybe have to pay some fines, et cetera. But I think at this level, I think you're buying a great business. You're not paying them a lot on book value for it as well. So, and the earnings were quite light, and I think the stock fell because of that, but I think that's the opportunity.
Okay. Next idea is Stryker, the medical body parts.
Right, yeah, device maker. Yeah,
equipment,
so they have a bunch of businesses from orthopedics, so knees, hips, spines, and they bought a company called Wright Medical, which does ankles and wrists. So what I like about this business is that there's a couple of things. One, 73% of their business comes from the United States, 21% from developed markets, and the remainder from emerging markets. So there's lots of opportunity. The second thing is that during COVID, there was these are all elective surgeries, so no elective surgery. So there's a huge backlog of surgeries going through, and which will helps them with a lot of their products. The other thing, there's a bit of annuity because one, if a surgeon uses this product, they don't switch to another product all the time. It's sort of, they tend to use the same products because they are quite technical. And the other thing is that as there's a demographic play, as people get older, they really need a lot of these kind of surgeries. It does help them. It keeps them off drugs. It keeps them out of the hospital. So that's really important. So I think there's a lot of growth in this industry over the next little while. I think they've got a great balance sheet. I think they will continue to grow their business through some acquisitions over a period of time. And I think that it's a great story, and I think that even though they get rid of this backlog and there's some cost issues with it, but I think they will do well going forward over the next several years.
Okay, and then finally, Johnson & Johnson.
So Johnson & Johnson was a company that we own. We really like it, and then one of the reasons we liked it is because of the three divisions that they had, which was medical devices, one of the like Stryker. They had pharma, and they had personal care products. They've sold off the personal care products. They spun it out. They did an IPO. They got a bunch of money for it, and then they spun out the rest of it through a distribution to the existing clients if they wanted it, right? So the personal care products had some great business, like they had shampoo and Tylenol, but they also had talcum powder, which people were worried about and they're being sued for. So one of the reasons we liked the business, because of these three businesses, they all offset each other at some point in time. We continue to like the two areas that they have with the cash they got from the IPO part of it. They can really go out and buy some more medical device acquisitions as well as some pharma stuff. And this is a company that's increased its dividend for almost 58 years in a row. I think that'll continue to happen. They've got a good balance sheet now. Also, there's this issue, but they're being sued. But those things take a long time in the United States, right? They go back and appeal all the time and stuff like that. And they've reserved for it as well. So I think that's fine. I think the stock has underperformed over the last little while, and you get this opportunity to buy it relatively cheap at 14 times earnings.
So you wouldn't let the lawsuits dissuade you here?
Well, I mean, these things happen a lot in the United States, and they don't always, they tend to settle these things as opposed to going to court and getting big, huge checks and stuff like that. And even if that happens, they then appeal. So I think what the issue is that they've done this before. It's not something that they're not used to, as any pharma company's is. But I think they have an opportunity to really make some decent acquisitions on the pharma side and the medical device side with the money they got, and really expand their businesses.
Paul, thank you very much indeed.
Always a pleasure.
Paul Harris has been our guest on Market Call. Let's get to those top picks. Horizons Marijuana Life Sciences ETF, HMMJ. Sounds brave. I mean, people have lost money on this ETF over the past few years.
That is correct. And not just few years, about 5 years.
Yeah.
So whenever you get in an asset class that has been down and down and down for 5 years, and it's critical that it be down for sort of more than 3, it goes through a period where people are uninterested. There's a significant amount of apathy, which reflects the valuations. And so we want to look across this landscape and look towards ETFs that might have exposure in this area. In this case, we're looking at the HMMJ, the life sciences ETF, but almost any ETF will do, and ones with more U.S. exposure might be a little bit better, and that's because the proponents of marijuana prohibition continue to modify their views in the U.S., and there's a lot of public support for recreational legalization of cannabis. And we're starting to see that in the news. The U.S. military is not testing for marijuana anymore as an illegal substance. In the election that happened several years ago, 90% of Americans supported the use of cannabis both medicinally and recreationally, or recreationally. So when you have an asset class that has such poor performance and you see this sort of pulse, and you see that coincident with the changing mindset, this is an opportunity. Maybe you take a smaller position size, as you say, Andy, maybe there's a bit of risk here, but I kind of think after 5 years of really, really poor performance, it's time to start taking a look. And, as I was preparing for this and saw yesterday's 8% day, I thought, oh, geez, that's too bad. But now, we see the pullback today, which, as you point out, is evident of the volatility. So this is a high risk sector. Might call for a smaller position, but boy, has it been beaten down. It reminds me of tobacco stocks in 1999 when CalPERS decided that they were not going to own any tobacco stocks in the portfolio, and Philip Morris had a 10% dividend yield. When you get to this type of sort of rejection of an asset class, it often presents an opportunity longer term.
Okay. Your next idea, the Evolved Global Healthcare Enhanced Yield ETF. That's Life B in Toronto.
Yes. And I would like the Life B. I want the non-hedged US dollar version of this, because if we get into a scenario where we are going through a growth shock, the US dollar tends to outperform the Canadian dollar. And the global healthcare sector is often resilient to those types of situations. It has more stability in a market drawdown. Now, in this portfolio, you've got an index of 20 securities. They're the 20 largest global healthcare. So big, sturdy companies. They're equally weighted, and they sell covered calls. They write those calls, again, on about a third of the portfolio, which is why it has that nice yield to it. So here you have a more conservative sector, more conservative group of securities that you're getting some downside mitigation on with your covered calls, or you're getting some income. And I think that's kind of the thing we want to look for in this particular market. We've got some upside. When we were talking about the regional banks, could be really good, could be really bad. In the global healthcare area, it's more narrow. Probably going to be pretty good, but not going to be too bad. Plus, you're doing some covered writing. Not a bad place to be given the circumstances.
Okay, and your final idea, the Vanguard Communication Services ETF, VOX in New York.
Yeah, the VOX is another interesting play. This is just another way to look at the lens of AI and exposures to AI. So it's a very unique index. Right now, the index is 19%, about 20% in Meta, 11% exposure. Well, let's call it 20% exposure to the combined Google companies. And then all the other holdings are below 5%. And there's some tax reasons for this structure. But it gives you some exposure to some very large opportunities. Meta is coming out with an AI version. Google is coming out with an AI bot that are getting a lot of attention, but it's also in the communication space. So you've got your Disneys and Netflix in there as well, but very interesting way to play that AI side of things without being in semiconductors. So I thought, investors might want something a little different than trying to look at the semiconductors, which we talked about in our past picks.
Yeah, it's a big weighting here in Meta, about 20% of the fund, and then the two classes of Alphabet, just over 20%. So big weighting in just those two names.
Absolutely. It is a concentrated portfolio in those names, but those names are very large companies, and the potential for them to benefit from the evolution of AI on their platforms is pretty substantial. So again, it's a slightly different way. Let's take maybe a smaller position size because of the concentration and because of the type of investment we're looking at here. But when we look at the probabilistic weight on How is this going to do? How would it do in a potential bear market? I think it actually could have some stability in the portfolio, even though it's quite concentrated.
Thank you very much indeed for joining us today, Mike.
Thank you, Andy. Always a pleasure.
Mike Philbrick. Let's get to the top picks. Yurbay Brands is the first one, trades on the securities exchange in US dollars. What are they all about?
Yeah, so really they're in the energy drink market down in the US. And if you followed Celsius, you saw how well that stock has done as they've continued to grow. And Yurbay is doing exactly the same thing. So they have a CEO that has had 3 successful exits out of the energy drink business. He sold to Coke and to Pepsi. And so he knows all the players. He knows how to do this. He's done it before. This time around, they're doing it with, zero sugar, plant-based, and hitting all all the socially and sustainable marks with their product. They've ramped up. They're about 5 years old now, and they're at the place where Celsius was. You sort of go back to 2016. They're kind of at that place right now. They're getting distribution across, kind of all the channels. They say at omni-channel, right? So convenience stores, grocery stores, the big box stores, and it's just a function of, continuing to build out that model, gain market share. And from what I understand, I haven't tried the product, but from what I understand, everyone who tries it absolutely loves it, and they have a great take back as far as people who repeat back buying the product.
Rekor Systems, REKR, on the NASDAQ. Tell us about them.
Yeah, so everyone's talking about AI and how it can be used, and this is just making municipalities more efficient. So if you go back to the days when people were counting cars manually, they can do this with systems. So they can install systems that can actually count cars, which help to with traffic flow. There was a story that I talked about previously on Market Call about a case where they kept seeing this one car going back and forth that kind of flagged in the police records. And so when they pulled it over, they were able to, check. And the guy who had been driving the car was actually trafficking drugs. And so they were able to, make a successful stop. This is one that they have got a number of different requests for proposal out to different states in the U.S., different municipalities. And we expect to see, a number of those signed over the next year. And so this is kind of just at the cusp of where it can really take off.
And finally, Quipt Home Medical, this company in various incarnations, I think you've been following, investing in for years.
We have, yeah. If you go back, it's had multiple different names and sort of iterations, but they continue to execute really well. They just did another transaction just recently here where they made another acquisition. The stock continues to do really well, or the company continues to do really well. The stock price has really bounced around. It's sold off recently. A couple of missteps, I think, by management where they did a financing and then announced that they were going to do an at the market financing. Kind of pulled back the stock a bit. It's now trading at very attractive valuation. So it's trading at about half the valuation of its peers and other peers in North America. And so it's just too cheap with the growth rate. And the CEO Greg Crawford continues to execute on all fronts, both organically and via acquisition.
I'm not sure if we have a longer term chart. So it's certainly had its ups and downs, this stock, hasn't it, Bruce? It's been a tough one to own for a lot of the time.
Well, there were certainly some times where it had, fairly big downturns. Okay. One of the things that, if you remember what happened, is it actually spun out Viamed. So Viamed and Quip used to be one company, which was patient home monitoring, going, kind of way back, almost probably 7 or 8 years now. Mm-hmm. And so, yeah, it did have some ups and downs, especially at the beginning. It was a lot like what we talked about with Salona, where they made all those acquisitions up front and then they weren't profitable, and then they turned it into profitability and then they split it up. So, it's an interesting company, but they're really in their groove right now and continue to execute.
Thank you very much indeed, Bruce. It's great talking to you.
Yeah, thanks for having me on again.
First idea, Amazon.com, the juggernaut.
Yeah, absolutely. This is a name that we really like. It's on almost $570 billion in revenue forecasted for 2023. It is the powerhouse dominant force in e-commerce, cloud services, digital streaming, and artificial intelligence. Its expansion into other industries such as healthcare and logistics that unlocks substantial growth avenues, but also diversifies its revenue streams as well. Of course, AWS, Amazon Web Services, its cloud segment is scaling very quickly. It's gaining a lot of traction and now commands about 1/3 of the world's market share in cloud infrastructure. The high margin advertising business, whenever you search for an item, you see the sponsored ads at the top. That's the that's the advertising business. That continues to gain a lot of ground and should enhance profitability going forward. When you look at Amazon Prime, we've got 200 million paying subscribers today. So that just sort of showcases the customer loyalty that we see for people that enjoy Amazon and Amazon Prime. And going forward, we're seeing a 25% plus EPS growth rate. So a lot of good things happening with Amazon. When you look at the chart, had a tough year last year, but it's rebounding, breaking out to new highs at this point. Chart looks great on it, at least on the short-term basis as well.
Fortinet is the next name, a big player in security, computer security.
Yeah, so cyber attacks are not going to go away. They're just going to keep coming. We already saw in the past week, the Weather Network got hit. We saw Caesars Palace got hit, MGM Resorts got hit in the past week or so. So Fortinet is a global leader in the cybersecurity and networking solutions industry, second only to Palo Alto Networks in terms of market cap size. Some of the organizations that they cater to would be enterprises, communication and security service providers, governments, and small businesses, of course. Long term, I think the cybersecurity market, we're seeing very robust secular trends. You've got escalating cyber threats. Again, we saw a couple this week already. We're seeing expanding digital transformation landscape happening. And then when you look at the substantial costs when you have security breaches, I think that corporations and governments will continue to spend a lot of their budgets on cybersecurity. And then you look at remote working trends, work from home trends, the Internet of Things. That's going to drive further growth for companies like Fortinet. EPS growth rate going forward is about 18 to 20% for FTNT.
Okay, it's interesting. I wonder, we hear about these breaches of customer records. I wonder, is it at a point at which we tell companies, well, you just can't keep customer records if you can't maintain security? Yeah.
It's possible.
If they can't do it safely, I mean.
Sure, but that's how things are convenient. Whenever we buy something on Amazon, your credit card's already there, your information is there.
Yeah.
It's a convenience of being able to say, click, we can buy it. It's coming tomorrow morning or tomorrow afternoon. And that's what we'd have to give up. So I'm not sure what the balance is, what the consumer will ultimately want. I think the consumer will ultimately want, hey, put more money into cybersecurity and protect my information.
We're shopping for a new washing machine. Our existing Maytag gave out after about less than 10 years anyway. And lots of the new models have Wi-Fi.
Right.
And I believe part of that is the appliance makers want to own you. They want your data. That's one of the reasons.
Yes, but the advantage of that is that you can be downstairs or wherever, another part of the house, and you know exactly the minute in which your wash is done or your dryer is done.
Yeah. In a way, I'd prefer no features and just have it last for 20, 30 years.
Sure.
That's me. But I see, I mean, it is amazing, the connectivity, okay. PepsiCo is your final idea, a staples play for many people.
Yes, and to the point about the washing machine, you can always buy a washboard off of Amazon and do the old-fashioned way.
That's true, yeah.
Pepsi's a name, again, one of these companies, if you pull the chart out to 10 years plus, it's got a great chart, ascending channel, higher highs, higher lows, upward channel. Revenue about $92 billion US expected for 2023. It is a leading global consumer staples powerhouse with a very diverse portfolio of beverage and convenient food brands. And some of these brands that everybody loves would be Lay's, Doritos, Gatorade, Pepsi, Mountain Dew, Quaker, and most recently about SodaStream. Very strong balance sheet, very strong, robust cash flows, will give you a very reliable dividend feature going forward, and more share buybacks going forward. So it's really a name for reliable growth with an income. So it's really great for those investors looking for that, steady growth and more of an income focus on the portfolio. Again, look at the past 10 years plus upward movement, great channel in the charts, lower beta than the S&P 500. So you get low volatility as well. You're getting a 2.8% dividend today, and that's expected to grow at about 7% going forward. That's in and about what historically Pepsi has increased their dividend going backwards.
Right. So they bought SodaStream, you said. PepsiCo did?
Yes. So I think that was a good year ago, if not
That's interesting.
more.
Yeah.
To diversify some of the revenue streams and get into some of the healthier type of markets that they'd like to be in, just given parts of the world and where we're going with more healthy type of drinks.
Thank you very much, Dan.
Appreciate it. Thank you.
Let's get to the top picks. Target. So you say there's stress on consumers, but Target's a decent bet.
Well, that's the idea. So what Target specifically, because we're bottom-up stock pickers, so Target is a general merchandise retailer in the U.S. They have 2,000 stores. They have $100 billion in sales. But unfortunately, in 2022, they had a huge margin implosion. So gross margins and operating margins all collapsed by almost 500 basis points. And that was really a function of, again, supply chain dislocations, the shift of the consumer from discretionary to necessary purchases. And that really affected Target's business model. We think, as we go forward, that Target will be able to right-size all of those supply chain issues. And if we just get back to a normalized kind of gross margin, operating margin type level for Target as we move forward, in the face of maybe the Fed reducing rates next year, then it's a great setup for appreciation of Target.
And so Dollar General, DG, has been a big disappointment.
Yeah.
Is Target, and Target stock is down from 2021, but are they doing stuff, do they have advantages that a Dollar General wouldn't have?
Well, they have buying advantages for sure, but for Dollar General specifically, they've actually flagged an interesting point in terms of their call, and they've seen an extraordinary large amount of increase in shrink. So shrink is code for theft. So Target, I mentioned that on the call too. So when you talk about the consumer and how stretched they are and put together the whole theft part of it, then it's kind of at the margin, it sounds like we're potentially under duress. But back to Dollar General, they actually are not as price competitive as Walmart. I saw a basket of goods comparison.
Wow.
So it's really when you look at the specific Dollar General concept versus a Target or a Walmart that you have to really compare them and see how their products line up. And Dollar General has not been very competitive versus a Walmart.
Morgan Stanley. Why do you like the look of this one?
So Morgan Stanley has been flat year to date, up 1 or 2%, not a lot. Their investment banking business has been weak, as we all know, and so is their wealth management business. So we think, again, as we go forward through next year, investment banking is going to pick up, wealth management is going to pick up, and it's really a trade on improvement versus the last year or so as we go forward. So we like Morgan Stanley. We think it'll go up above $100 in the next 12 to 18 months.
Right. And why would you favor Morgan Stanley over some other banks?
It's the one we've owned for a long, long time. We're very, very comfortable with the management team. They've delivered time and time again. So when you look at it versus some of the money center banks or Goldman Sachs of the world, it's the one we've really become familiar with.
Oh, okay. And then finally, let's have a look at Thermo Fisher Scientific, obviously maker of scientific equipment, testing equipment, all that.
Yeah, so Thermo Fisher has spent the last 15 or 20 years consolidating the health sciences, tools, diagnostics market. And now they're the behemoth in that. So they're sciences, they sell to the sciences businesses. So they sell to pharmas, biopharmas, tools, diagnostics, and health providers. And because those sectors they sell to are so robust, given the demographic profile and all the new scientific breakthroughs and acceleration in that we're seeing, Thermo Fisher should be able to achieve at least a 7 to 9% revenue growth, along with a low double-digit earnings growth. And we wouldn't expect a multiple increase for Thermo Fisher, but we'd expect it to just grow slow and steady with that earnings growth of 12 or 13%. So it's a great compounder.
Okay. Thermo Fisher, the final idea. Thank you very much.
Yes, thank you very much.